Okay, so we're going to talk about corporate liquidations and reorgs for Chapter 18. Kind of interesting chapter, kind of the chapter of what do we do when everything goes wrong. So we're going to look at the different types of bankruptcy filings, the trustee responsibilities of an accounting during liquidation, financial reporting during the reorg, and the financial reporting after the reorg is done. All right, so first we're going to look at the types of bankruptcies. So insolvency, there's equity insolvency, which is basically the inability to pay your debts on time. So remember, walking back to our equity, we have our stockholders' equity, and we have our liabilities. So when the liabilities become so much that we're unable to take care of our short-term liabilities, that would be a equity insolvency. And not necessarily in an equity insolvency does that mean that we have to throw the baby out with the bathwater like a bankruptcy insolvency. A bankruptcy insolvency is when you have debts and you're not going to be able to pay back anything. You're not going to be able to make it. You've gotten to the point where not only can you not pay things on time, you can't pay things at all. So with the bankruptcy, it can be liquidated or it can be reorganized. Usually in a Chapter 7, everything just goes out the door, or it can be reorganized as some of the debts can be written off and some of the debts can still be paid. All right, so speaking of the different types of bankruptcy, we have the Chapter 7. You've all heard of that one. Basically, what happens in a Chapter 7 is a trustee is brought in and everything is sold off. Then the other one we have is a Chapter 9, which is basically the adjustment of debt of a municipality. So that would be like when you all were in government accounting with me, and if you weren't, I can send you the link. When we talked about Orange County going bankrupt, that would be the municipality's debt. Remember the government bonds and that sort of thing. Reorganization is when they expect to get the debtor back on their feet. So that would be a situation where maybe we can't pay the bills right now. Maybe we're in a downturn. So we're going to go in and try to reorganize the debts, maybe change the terms, or even let some of the debts go. Chapter 12 is for farmers. Farmers bankruptcy is a little different. And then Chapter 13 is an adjustment of debts. So some of the debts will probably be let go or adjusted down or negotiated. Remember that in some situations, interest and fees are negotiable, but most want their principal balance back. Okay, so now we're going to look at the difference between voluntary bankruptcy proceedings and involuntary bankruptcy proceedings. And one of the things that I wanted to bring up is the actual cost. So the cost of a reorganization, like if your company is doing a reorg, is more expensive than just basically doing a liquidation and starting from scratch. So if you were doing a cost benefit analysis and you were trying to decide whether or not you were going to do a reorg or a Chapter 7, I would consider looking at the final outcome of cost in that decisioning. All right, so let's look at the trustee responsibilities. So in a liquidation or a reorg, the debtor corporation has to go and file a list of creditors and a schedule of assets and liabilities in their statement of financial affairs. And then what happens is the trustee is appointed. It's usually a lawyer. And basically what happens is the management leaves the company. A trustee, who's usually a lawyer or some sort of high-level financial person, comes in and starts paying and basically does everything they can to kind of pay up the bills. Setting the assets to satisfy the liabilities. The trustee will also go in and appear at the court hearing. And what happens is the management kind of surrenders their ability, their responsibility, and their decision making to the trustee. So basically, the idea of a liquidation or a reorg basically is the managements lose their power, and the trustee basically steps in and takes over with the goal of getting all the bills paid. Okay, so they basically investigate the financial affairs. examine the creditor claims, file a report on trusteeship, and they're usually, so it says if authorized to operate the debtor's business, that usually kind of comes in and they kind of come in and do a lot of the operations most of the time. And then in a reorg, they will file a organizational plan or a statement why it can't file. So let's look at the ranking of claims. So I kind of like preclude this to ringing the dinner bell and everybody lining up for dinner, and there's only so much food to go around. So so when you liquidate, obviously you're not going to have enough to pay everybody, because that's why you're liquidating in the first place, is you can't satisfy your claims or your liabilities. So the ranking goes like this. The first thing are secured claims. Actually, you know what? Let me just straight up say this, because there's been so much debate going on, particularly with the circumstances revolved around COVID-19, certain businesses closed. The first person that get paid in a liquidation are the employees. I'm just putting this in here because it is not, it's not in here, and it should be, but you have to pay your employees first. So if you have a situation where you can't pay your other liabilities, you have to pay your employees first. And the thing that people run into is they have to choose between making their rent for their building or paying their employees. And the rule is that you have to pay your employees. So if you can't pay your employees, but you can pay your rent and keep the business open a little longer, you have to close the business, basically. So, okay, with that in mind, secured claims. Secured liens are claims that are secured by valid liens, usually a uniform commercial code. Financing statement is attached to the loan. It also could be secured claims. For example, accounts payable, like if you have, if you go ahead and are allowed to go on account through a note, and the note is secured by some sort of property, that would be a secured claim. If you set up an accounts payable and there is no security interest attached to that, then that does not fall under secured claims. It would be unsecured. So unsecured priority claims. So administrative expenses in preserving and liquidating the estate. In other words, the trustee gets paid after secured claims. So if you were to become a trustee in this particular situation, after the secured claims are paid, you wouldn't want to necessarily take the job on if they don't have enough to make their secured claims, which is, you know, usually supported by the selling of the items that are used to secure it. The second thing is claims incurred between the date of filing involuntary petition and the date the interim trustee is appointed. So anything that is in between the petition of bankruptcy and the interim trustee appointment date. Claims for wages and commissions earned within 180 days of filing and not exceeding $12,475 per individual. Okay, so again, if you have the money, you have to pay your employees before your rent. Again, employees should always be paid before any other claims. Claims of governmental units for income and gross receipts, property taxes, employee taxes. Once again, the tax man is in line for this. Unsecured non-priority claims. These are anything that that doesn't fall underneath secured and unsecured. So again, once you pay your secured liens and you pay your employees, everything else is third in line. And then finally, stockholders' claims. And that would be the preferred stock first, and then finally the common. Okay, so a statement of affairs is a legal document prepared for bankruptcy court, and assets are expected at their net realizable values, not their historical cost. Classified on the basis of availability for classes of creditors, and then assets are priority, fully, partially, and unsecured classified. We include historical values, but we're not going to use historical values. It's sussing out whether or not we can pay these claims. We'll do it at the market value or whatever the value may be. Let's look at CAM, Corporation Statement of Affairs, and you can see the estimated realizable value less secured creditor liabilities. So again, we're not using historical cost. We can put it there for reference, but we're not doing a historical cost when we're looking at the assets. The idea is that we are shutting down now, so we need to go with what we're going to be able to pay for. So the land and the buildings are net of depreciation, less your mortgage payable and your interest payable, so that will be subtracted out, and then your actual amount to available for the unsecured creditor is $5,000. All right, so again, the net realizable value less what you owe. Same thing for partially secured creditors. Again, you have an accounts payable and a note to the bank plus the interest. All right, so nothing goes to unsecured. Here's a little point I want to make too, okay? A lot of people during bankruptcy think that you can wipe out the interest. It's just a little thing that people think. The idea, and it doesn't seem fair. It seems like you should probably be able to get the note paid, but then maybe wipe off the interest. You have to be able to wipe it all off before it goes to the unsecured credit. Okay, so let's look at the statement of affairs. So again, statement of affairs, you can see here the book value is used as a reference, and once we have taken out the creditor liabilities, we go through each of these items and see what's available for unsecured creditors. Now remember, unsecured creditors, because the secured creditors have been attached to things like the building and the mortgage and that sort of thing, they're not in the running. Once that's been satisfied, the unsecured creditors are the ones that get the opportunity to get the cash, security, inventory. And I would definitely look at that inventory and do a lower of cost or net realizable value on that, because if the company is going bankrupt, chances are its inventory is not worth that much. If it was, maybe it wouldn't be going bankrupt. Equipment net of depreciation that's not secured. And so you could take these intangible assets, we're on 6, valued at 0, and then this is all that's available. And then we go in from priority liabilities, taking that out, and available for unsecured. So there's a little bit left over, not that much. All right, so let's look at secured, the liabilities in the stockholder section. Again, the mortgage payable and interest payable, these are security interests right here, so they go to the secured priority claim. The note payable for the bank and the interest is also going to the secured. Wages payable right here, priority liability, wages are going to get paid, as well as property taxes. All right, and here is the pledges. The unpledged accounts receivable, once it's been satisfied as pledged, the rest goes to everybody else that's unsecured, as well as the accounts payable and the notes payable to suppliers, unsecured. And again, just to reiterate, unsecured versus secured. Secured means that you're pledged some sort of collateral against the loan. Unsecured means that you haven't. Again, accounts payable, a note payable supplier. If I was a supplier, particularly if I was dealing with a client that was new, you know, and you're pushing out a lot of product, doesn't hurt to try to reach out and get some sort of security interest, depending on what you're supplying and that sort of thing. All right, trustee accounting. The trustee creates a brand new set of books. During the case, they'll record the transactions, cash receipts and disbursement, changes in equity, and statement of realization and liquidation, basically what we're bringing in, what we're settling out. And then finally, the They'll do a final settlement on the claims, go from the bankruptcy judge, and then the trustee completes their job. So I actually got a great opportunity to talk to someone in the legal field about why you would appoint a trustee. And one of the things that that person told me is that a lot of times the judge will appoint a trustee when they have reason to believe that the people running the company are not going to act in the best interest for the company. So the thing that it is nice about having a trustee is a trustee is an outside uninterested party. Their goal is just to get the bills paid. So for that reason, the judge may be wanting to appoint a trustee. However, if they feel like the management can continue to run the company while in bankruptcy, then the judge may choose not to appoint a trustee, and instead then they would become the debtor in possession, and they would go ahead. They would still have the same responsibilities as the trustee in a reorganization. So, for example, and I'm just spitballing here some ideas. Let's say we have a situation where, because of an unnatural event, like for example, a tornado hits a company, and they're unable to do business, but they've been up until this point working out pretty well. Then they might consider just letting the management continue to run and doing a reorganization as they try to settle their debt. All right, so the creditors committee is elected in a liquidation case and appointed in a reorganization case from the largest unsecured creditors. And they basically, so if you have a bunch of creditors, and some of these companies can have thousands of creditors, sometimes having everybody show up to the courtroom is a lot. So what happens is they put together a creditors committee, and that group comes and makes decisions on behalf of everybody, reviews the transactions of the debtor in possession and can object, and handles negotiations with any creditor regarding the settlement or continued business. So basically, the committee kind of acts on behalf of everybody. Okay, so let's talk about the benefits of Chapter 11. You can cancel unexpired leases, reject executory contracts, and you have legal protection from creditor action, such as lawsuits and repossession of properties. However, being a debtor in possession is very, very difficult because you have the stain of being bankrupt and everybody knows about it. So it may become more and more difficult. Again, I would look at why you went bankrupt. Did you go bankrupt because it was mismanaged, or because of some a natural event? I can imagine. I actually did some research on this, and because of COVID-19, they're already starting to redo the way they do the court system for bankruptcy, and there's a bunch of guidance out there. If you have time, go take a look at that website. It's very interesting how they're going to manage this, because they're getting ready. There's going to be a wave. Unfortunately, it's a very sad situation. So, okay, so you can also do a reorganization plan that can be filed at the time of bankruptcy, called a prepackaged bankruptcy, and you can do it by the debtor in possession within 120 days of filing. Other interested parties may file proposed plans after 120 days. And basically, it goes in, it identifies the claims, gives a payout for each class, and all the claims within each class are treated alike, and it's got to be fair. Okay, so let's look at the balance sheet. Pre-petition liabilities are subject to compromise, so that means they can be argued a little bit, and are reported as a separate line item in liabilities. These are things that arose before the filing and include unsecured or undersecured liabilities. So, for example, if you don't have enough of a security interest on your financing statement, you can put this in. You would be partially secured, but not fully. They're usually paid at less than the face value. So this is the part where I was saying wiping out the interest. You can't wipe out the interest in secured, but you can in unsecured. Pre-petition secured liabilities and post-petition liabilities are reported normally. All right, reorg costs are shown separately, interest to be paid or probable amount, and there will be differences in contractual amounts. Stock and stock equivalent issuance should be disclosed, and cash flow items related to reorg are shown separately. All right, so if there's an incoming item, you show that different, you show it in a separate line item. All right, so condensed combined financial statements are prepared for all entities in the reorg proceedings as supplementary information, intercompany receivables and payables, and any write-downs. And there will probably be a lot. Remember from the previous chapters, I think it was 5, the excuse me, the elimination of intercompany receivables. You definitely you'll want to show that in your combined financial statements. So you're going to be wanting to show that, because maybe if you're a sub and you're going under, but you're the parent, you have to show it now. You can't swipe it off. Okay. Corporate liquidations and reorgs. Okay, once you're done with the reorganization, you approximate the fair value of the entity without considering liabilities, and you have to discount future cash flows of a reorg business. So those are the ways you would want to approximate the fair value, and a lot of it, full disclosure, coming down to cash flows, like how much is coming in. That's really going to drive your reorganization value. So I'm just going to use the airlines as an example. Most likely there will be a huge reorganization within all the airlines based on this most recent event. There will be some that will either merge or go under, or they will have to do some sort of run through. I think even with the bailout. So what's going to happen is they're going to have to use discounted cash flows. The problem with that is post shutdown, no one really knows what those future cash flows are going to be, because I think there's going to be an effect on how the business is done. So trying to project cash flows after 2020 is going to be kind of challenging. So again, approximating the fair value. What I would do is I would go in and use some comparison cash flows after similar but not the same event. So one thing they could do is come in and maybe post 2001 and look at how that affected the airline cash flows, and use that as a starting point with the emergence of 2002. And then maybe build a build out, because I really don't know how they're going to come up with this. I think it's going to be a lot of throwing darts, which is really going to mess up the valuations and the earnings reporting, but that's a whole nother story. So, okay, so Fresh Start reporting recognizes that a merging company is a new entity. To qualify, the revaluation immediately before and after the reorg plan is confirmed, but must be less the post-petition liabilities and allowed claims. Holders of existing voting shares receive less than 50% of the emerging entity. So that's something that, again, it's kind of how they do it. All right, so okay, so actually after working on this and rereading about Fresh Start, I actually did a little more research and found out that Fresh Start accounting is basically purchase accounting. It's analogous to purchase accounting, which we studied in the first 2 or 3 chapters. There is one thing that I found incredibly interesting in my own personal research is this case of U.S. Airways. I actually got this from the Bankruptcy Institute. It's very interesting. As we all know, U.S. Airways was purchased by American Airlines. And this is a great example of a airline that basically was in trouble, did their Chapter 11, did not take the pill of a write-down, and then was not able to basically save themselves. So what happened was they had $3.9 billion of PP&E and $500 million of goodwill. And so they basically went in, this is using purchase accounting, they reevaluated everything and did fresh start. So they got everything on the balance sheet as it was actually valued, which was $3.2 billion of PP&E and $2.4 billion of goodwill. Okay, and then they put that in the footnote, a fresh start footnote to the financial statements. So what this looks like to me is we took a $700 million write-off of assets, and then we just popped on all this goodwill on the balance sheet. My question is, how does a company in bankruptcy get $2.4 billion of goodwill? I mean, I'm just thinking this out loud. So what happened is they also did not take an income statement charge to change in estimates. So they had some changes in estimates for pension liabilities, post-retirement benefits, and litigation settlements that were very significant. And had they been able to do that, had the problem is if they were able to do that and they were able to emerge against that charge, they would not have had to write down their goodwill. Because they didn't do that, now they were faced with having to do something with this $2.4 billion in goodwill. So what I kind of thought of this when I was reading through this case, and I mean, I am not a bankruptcy expert, but this just felt like a Band-Aid on a cancer, to be honest with you. I'm looking at this and thinking, man, that is a lot. I've never seen a bankruptcy where they actually wrote up the goodwill. I could see it in technology, maybe, but the name reporting, the goodwill is basically supposed to be the brand significance. How they were able to up that goodwill in the middle of a bankruptcy, I don't fully understand. And maybe in our discussion group, you all can enlighten me. So this is one of those where I'm going to plead the fifth, literally, dealing with all this legal stuff. But I found that one very interesting. So I hope you enjoy reading this case. Okay, once again, if a company does not qualify for Fresh Start, they report the liabilities in the appropriate interest rate under GAAP. And then debt forgiveness is set as an extraordinary item, which will definitely alert investors and financial statement users that something is going on. All right, so let's look at a reorgan example. TIG files for bankruptcy under Chapter 11 on January 5th, 2016. Accordingly, it reclassifies pre-petition liabilities, obtains short-term financing, acquires additional equipment, continues operations through June 30th, 2017 when the plan is approved with a reorg value of $2,200. Okay, so let's take a look at thing before and after, and you can see here when they filed for year end before, and then the revaluation, the cash, AR, inventory is marked down, other assets, land is marked down, revalued, buildings revalued, everything is gone, is basically taken out. We subtract out everything after the revalue. You can see the differences in here. So they go in and basically revaluation or take it off. Okay, and then of course the fair values are reassessed. And you can see here before with the revalue 375, and here, and you can see here this is added in. All right, and you can see here 75 is subtracted out, 30 is subtracted out, 125 is subtracted out. Okay, so again, everything balance sheet and equity, these are all added together for the liabilities, and then they're redistributed at the end after the revalue. Basically, everything is just adjusted in. I'm just trying to see if there's anything else about TIG that I could share. Can TIG use Fresh Start? That's something. On 6/30/2017, there were 255 in post-petition liabilities. All 2,300 pre-petition were allowed by the courts. Firm value is 2,200. Okay, so here are the two rules. Does liabilities exceed organizational reorg value? And old shareholders retain less than 50%. And if that's the case, yes, then Fresh Start is appropriate. Those are the two check figures or checklist. All right, this concludes our lecture on the bankruptcy proceedings, and hopefully you got a lot of information for research, particularly how that one case of goodwill was treated. And hope you're all having a great time. We're getting close to the finish line in this class, so keep up with it. And we'll be wrapping up soon. Thanks a lot for your time. Have a good day. Bye.